let's move on to our next session, which is basically post-pandemic world economy, redrawing the map of global wealth and economic power, which is moderated by Mr. PD Singh, who is the MD of JP Morgan. And we have a very distinguished panel there. We have Mr. Ashwini Kumar Tiwari, who is MD State Bank of India. We have Mr. Mangal Goswami, ex-IMF and ED of Southeast Asian Central Bank. So let us welcome our panelists, and it is over to Mr. PD Singh to take this forward.
Thank you, Deepak. And firstly, congratulations. I think you've had a very strong start to your conference. It's really nice to see the very strong participation as well. Want to welcome our very distinguished panel members and quickly introduce them before I get into asking questions. So I'll go first with Mangal Goswami. So Mangal, as Deepak mentioned, is the Executive Director of the Southeast Asian Central Bank Center. He's based in Kuala Lumpur and very kindly joined us from offshore. He reminds me that 18 central bankers are his bosses. So it's really a privileged position he is in today. He's done a similar role as IMF South Asia Regional Head in Delhi. And similarly, for the IMF, he ran the STI in Singapore for 6 years. He's been a senior economist and is an expert on monetary and capital markets. He's also one of the foremost thought leaders on the global financial crisis, having seen it at very close quarters. He's been a member of various IMF working groups during this period. Of course, he's also worked for some of the largest banks in the world. He was the economist at ABN AMRO Bank in Singapore, also during the Asian financial crisis, and was also on the research department at the Federal Reserve Bank at Kansas City in the US. So welcome, Mr. Goswami. Mr. Ashwini Tewari needs no introduction. He's one of the most distinguished bankers we have in the country today, someone who's worked across the world. He's currently MD designate of State Bank of India. So like I said, one of the senior most bankers we can find in India today. Mr. Ashwini Tewari has been the MD and CEO of SBI Cards. He's currently dialed in from Gurgaon, moving to Bombay very soon. He spent 3 years as CEO of SBI's US business. Let me assure you that is a business that is almost as large as some of the other banks that we see in India today. He has extensive experience in similar roles in the other part of the world. So he was the regional head controlling many countries. The ones I can remember are Hong Kong, China, Korea, Japan used to all fall under him. And again, a very large business for SBI. So apart from that, he's done many other interesting positions within SBI. Of course, he's an electrical engineer and done his management from XLRI. He's on many boards, some of which I thought I can mention. So he's on the board of the International Institute of Bankers in New York. He's also on the board of the University of Washington Global Bankers Program. Mr. Tiwari runs and reads and does a lot of stuff. He believes in making a difference, and I'm sure we are all going to be really enthused to hear from you today, Mr. Tiwari. Thank you for joining.
Thank you, Mr. Singh.
So my first question is to you, Mangal. I think those who say that there are no letters left in the alphabets to describe the global economy are probably right. So it's not going to be a V shape. It's probably not an L shape. There's not going to be long periods of stagnation. But we are seeing intuitively what we thought will happen, the deglobalization, the way economies and governments are reacting and accelerating to protect themselves. Cross-border flows and flow of money are moving in different ways after the pandemic hit. So I just wanted to get from you, how do you see this play out from your vantage point? Do you think there are those who will benefit and those who will get left behind?
Thank you, PD. Thank you for inviting me. me in to this webinar. Pleased to be here and honored to be here with Mr. Tiwari as well. Thank you. Very quickly, I wanted to first just have a quick, wanted to mention about the pandemic's depth and the breadth of this pandemic's destruction of the real economy as well as the financial sector. It's really one of its kind. It has thrown hundreds and millions of people out of work. People have lost their lives. There are some projections which show that going forward, the IMF is saying that it could wipe out up to $28 trillion worth of output in the next 5 years. That's sort of the severity of this crisis. That said, of course, the fiscal support and the monetary support in the first 6 to 8 months of this crisis has been incredible. Over $12 trillion spent in fiscal, which has provided a significant support. We never know the counterfactual, but clearly, growth has, so there has been some rebound. Of course, the bridge to recovery is a long and fraught with uncertainty, and we are seeing some green shoots, but at the same time, the resurgence is sort of creating of infections is creating a temporary headwind to this recovery. So in terms of different regions, the US is seeing some kind of a temporary, probably adverse shock given the rise in infections, whereas on the other hand, China was the first one out of its blocks and is progressing relatively well. Europe is somewhere in the middle now, and Asia overall is also likely to see a bit of a recovery, but at the same time, it's also facing the similar headwinds. So that said, I would say that going forward, the region is going to benefit clearly from this, because as we have seen, there is a lot of adoption of technology and digitization. I think there's some disturbance because of the muting of the mics, but maybe I will continue. So I think Asia is going to be a beneficiary out of this. Clearly, because there is a massive push towards digitization, and Asia is on the frontier of that. Very quickly, I just want to also point out that the winners and losers in this whole recovery will likely be partly determined by the kind of fiscal buffers or fiscal cushions that one has, because given the depth of the crisis, given the breadth of the crisis, we are still not there yet. Therefore, you will need a lot of fiscal support going forward, because businesses are not able to earn the kind of revenues they should be otherwise. So this is going to take a long time, and countries that have managed their fiscal house well and have fiscal buffers and are also fighting this health crisis in a well-managed way are the ones that are likely to get ahead going forward. Of course, going forward, we will see the whole landscape be determined more and more by who adopts to this new way of doing things: digitization, technological transformation. We are also learning important lessons that you have to be ready for such systemic hazards by building buffers. Economic efficiency is not always everything. It's about building buffers so that you can be ready when the tail risk sort of materializes. Another big area, I'll stop after this, is the whole issue of sustainable finance, because there is quite a lot of push towards a greener recovery to take advantage of this situation and move forward with a more greener recovery, because as we know, pandemics can create massive destruction. So going forward, we also want to be much more aware of environmental and other social issues, and that will become part of our financial decision making and will be hardwired into our system. So countries that adopt this quickly are also going to be moving forward faster. So I'll stop at that, and we can have discussions later on. think PD, you are muted.
Hello, can you hear me? Yes. So thank you, Mangal. And Mr. Tiwari, I'm going to pick up from what Mangal mentioned about the digital efficiencies that are coming in. India is surprisingly ranking at number 14 on the World Digital Competitive Ranking. And though we spend less than half a percentage point of our GDP on research and development, we are still 16th in the emerging world of digital sophistication. But that also brings into our mind the rising gap between the skilled and the unskilled parts of India, or the skilled and the unskilled workforce in India. And from your vantage point, again, it'd be great to know how you see all this playing out in the Indian context as well.
Thank you, PD. And first of all, I have to congratulate AIFM for the really good sessions which they have put up here, and some really nice viewpoints coming through. I was just watching Mr. Sharma before this panel. So your question is actually very deep, because this distinction between the digital haves and have-nots. Before we go there, actually, we have to acknowledge that in terms of digital adoption, despite spending, as you said, less than 0.5% of the GDP on digital, and therefore being 16th in the emerging markets, India has really done well in digital. Now, how has this happened? Because the building blocks for digital, which are basically the widespread adoption of smartphones, and for that, we have to thank the Chinese mobile phone suppliers, even as there are other issues with China. And they really made the mobiles very affordable, the smartphones, and they're with a large proportion of the population. The data in India continues to be the cheapest in the world. And while there are questions about the viability of some of the mobile companies on this, who are not very happy that the costs are so low, but we have to still credit the fact that because of this low cost data, the mobile, the smartphone, and the data together have really enabled a lot of Indians to get into the digital world. Now, while large part of that is still social media, where people have gotten, but other lot is also to do with a whole lot of adoption of digital payments. We know the UPI story. In payments, it doesn't need repetition, but many times I see this, and I compare this with what's happened in US and earlier in Hong Kong. I still think that the Indian digital payment space is the laboratory of the world. I mean, every major player in the world is here, and they are all doing their thing, and they are succeeding in doing their thing, and on top of the UPI rails. And there are so many experiments going on. So therefore, that has enabled this digital payment to pick up like anything. So all the building blocks are in place: data, mobile, smartphones, all. Now, how can we improve this? How can we take this forward? And what is the gap between the haves and have-nots? So one thing which perhaps can be done is that one is that the smartphone prices, can they go down further? Now, the government, as we know, has rolled out a PLI scheme, performance linked incentive scheme, for electronics and mobile manufacturing, which is a very good step. This is the first one, and this will probably take off very, very quickly. So therefore, on that particular scheme, and also the fact that we need to work on the feature phones, because there's a lot of population in India which is still with cheap feature phones. And if we can enable this digital adoption on the feature phones, I think that would be a good thing. Of course, the other thing is reducing the cost of smartphones further. So these two things, plus the other thing which is happening already, and I think it is being taken up, government will also push it, is the adoption in terms of vernacular languages. What we have seen in our company, which is SBI Card, is that when we started reaching out to customers in the vernacular SMSs, and today we support 8 languages, and also the call centers through vernacular, the pickup from customers and the understanding was exceptionally better. So therefore, that is the third leg, that after the adoption of the smartphones, reduction in cost, the data cost, you got to go vernacular. So all of these together are actually pushing the digital world, not only from the major metros to the remotest towns and cities, but also to the people who are not perhaps so well off. So even somebody who's not so well off still is able to reach out to the digital world and do transactions and pay by Paytm or by other means. So that's a very, very good thing. What we have also seen in the bank, and we have to acknowledge that the big tech players have actually left behind the banks in terms of adoption of the UPI payments. and the banks have some work to do actually to get back there. But nevertheless, the next step is the adoption of adoption of the digital technology to serve the loans, the other financial payments. And a lot of work is getting done. And what we see in our company and also a lot of fintechs who work with us, that the transaction-based funding, which is happening now with the big platforms, whether it is the Amazon Business or GPay or even for that matter Paytm, and we are talking to a lot of these players to enable this even with us. So that is the next big thing, because even while all this is going on, we have to acknowledge that the MSME, which is, and also basically this segment is still very, very underfunded. So it is starting from low level of transaction based funding, but this has a big future. And together with the OKN network, which is being set up separately for MSMEs, I think we have a good sense of a lot of digital lending, which will happen very, very shortly. So in addition to this, of course, sales of other financial products digitally is also picking up. So with the future looks very, very good, and all the digital have-nots, I'm sure with the expansion of the broadband by the government of India, which is necessary, only the mobile internet may not be enough. I think this would be something, and that probably is not in the 0.5% which you mentioned in terms of digital R&D. So I think we are at a very, very bright future going forward.
Thank you, Mr. Tiwari. Like you said, the divide, though it is large, I think the future is also bright. Mangal, my question to you is on the asset price bubbles, which are stemming from what you alluded to earlier, the ultra-lax monetary policy, and the divide between those who can invest in financial assets and those who can't is also something that we are all seeing coming to the fore right now. So is this a temporary phenomena where people will move away from physical assets to paper assets? Or do you think this is a more sustainable long-term impact on different parts of the world? You're on mute, Mangal.
Thank you, PD. And before jumping into this question, I also wanted to add that indeed central banks are also thinking about central bank digital currency. So that's again, another dimension of digitization that is taking place. But now to your question about the real financial disconnect. Clearly what we have seen more notably in advanced economies than in emerging markets or frontier markets is that the discount rates have fallen significantly. As a result, what we have seen is risk premia and risk-free rates have gone down significantly. And having gone down so significantly, they have lifted asset valuations. And that has indeed supported financial markets. But to the extent that these financial markets and the transmission of this goes into the real economy through consumption, through higher investments, that is yet to actually pan out, and we are not seeing that in a significant way. And more notably, what we are seeing is that in the advanced economy, especially where the rates have pretty much hit the zero lower bound, there the central banks have been involved in balance sheet expansion. So the balance sheet expansions lend themselves much more towards financial assets, where financial asset prices are boosted by such interventions. It's not clear whether some have pointed out that in especially advanced economies where you hit the zero lower bound and such balance sheet expansions have taken place, there the transmission to the real economy has been much more difficult, because that is not the normal way of an economic transmission of monetary policy into the real economy, where we are not really very clear, or we do not know the plumbing of how that really happens into the real economy, and investors are also not very confident about as to whether such high valuations sort of command, they're not confident that they should be investing going forward with such kind of uncertainty being there. So overall, I think this divide driven by financial assets is more of a phenomenon that we are seeing in the advanced economies, notably in the US. But bits and pieces of that are also now spilling over to the emerging market world, as we are seeing that some central banks are delving into some kind of quantitative easing. The jury is still out as to whether this kind of quantitative easing will actually translate to real economic activity, because this is something new in this world. But from what we see is that there is still room for many emerging market countries to bring their policy rates before they hit the zero lower bound. So in that sense, the normality of economic policy making or monetary policy making still remains, in that. So to that extent, I think we know that real activity could actually, increase. The other aspect I wanted to point out is that notably in many of our countries in Asia, there is a high degree of informal workers, informal employment. So there, this kind of disproportionate, financial market sort of valuations do not really, help them, or the informal sector sort of gets left behind, notably so. So I think, as I said, the real and the financial disconnect is more notable in the advanced economies. But the jury is still out as to whether in our emerging market world, this is going to become more of an issue.
Thank you, Mangal. That's really insightful and great to know what's happening across the world, as well as emerging economies and what to expect in the future. Mr. Tiwari, closer to home, we've seen corporate profits expand by 30%. But at the same time, we've seen GDP is going down by 7.5%. So it's the wages versus profits that seem to be intuitively completely at a disjointed kind of incongruent. So help us understand exactly what is happening. Delinquencies are going up, but profits are going up as well. GDP is going down. So please help us understand what's happening.
So yes, this seems like a lot of dichotomy and like disconnect between what is happening. If the sales have been falling, which they are for a lot of companies, and yet the profit seems to be going up, whereas we know that wages are either coming down for a lot of people, or their incomes have come down. Some have even lost jobs, and also it's a very difficult situation out there. So the only short term, this is short term, definitely, because this cannot continue. That the companies in Q2 they've shown very good results. There are only some of them whose sales have actually gone up because of the pent-up demand, and we can count the two-wheeler industry perhaps, or the rural linked industries where the rural demand has been pretty good. So in the cities where the job losses or the income losses have happened, actually, that demand is down. We know that because the GDP is contracting, and even though it is not contracted by that much as in Q1 or as was expected by a lot of people, and maybe we'll have a better rebound in Q3 and Q4. But clearly, the urban demand or the metro demand is still way behind what it should be. These companies who have shown good results, partly due to the rural demand, but also partly that a lot of cost has been saved. So, for example, in Q1, I mean, if I talk about our company, we saved a lot in Q1 simply because everything was, and therefore the activity itself, which used to happen, not happen. And while we also negotiated the contracts and the other, let's say, rentals, etc., and to some extent, that is not the major component. The major component is the variable cost, which is coming from the lack of activity. So the first 2 quarters, I think that is for those companies whose demand is linked to the urban centers and the metro centers that are pan-India. So I think the main reason is the cost savings because of the lack of activity. That is my sense. Having said that, this is about to catch up. My only hope is that while this catch up happens in Q3 and beyond, whereas unless the sales improve, unless the revenues improve, and they will be driven by demand, this shouldn't be the case. Either the profits are going to come down or demand is back. Having said that, there's still a lot of way for the urban demand or people whose incomes have come down, and this continues. And those who have lost jobs, perhaps, we see this intuitively on LinkedIn and people asking for jobs, etc. So there is still a lot of pain which is going on, especially in the larger cities. So our only hope is that as the rest of the market opens up and there are deep reforms being pursued by the government today. Agriculture definitely, with all its controversies, is there, but there are other reforms being. The other thing which I do hope is forward, perhaps the government will rethink on the joining the trade blocs. That's not a good time to talk about it in context of the RCEP, but perhaps the TPP, when the US decides to join it, India should decide to join one of those trade blocs, because ultimately a free flow of trade and services is in the interest of India. So therefore, with all of these factors, the reforms which are taking place, I think a couple of quarters we have a challenge. And once the vaccine is available, even if it is not widely available in India, the animal spirits, if you will, come back, and the industry starts to invest more, because that's the other leg which is missing. The industry has not been investing. They've been investing outside India, not so much in India. So that is the other hope. In addition to demand coming back, the industry must start investing. So that's where we are. I guess it's a very iffy time at the moment. This disconnect would not continue, definitely.
Thank you. Very insightful. I'm reminded by the organizers that we have over 910 participants, financial professionals. They are very eager to ask you questions, so I will hold back mine and ask for some of the audience questions so they can also have a chance to interact with you.
Thank you so much to all the dignitaries present here and sharing wonderful insights on the topic which we all are eager to hear. So, sir, yes, we have one question from the participant. Mr. Akshat is asking, with central banks exhausting all the tools in their monetary policy arsenal to generate growth in the economy, once the economy does revive, do market risk the repercussions of excessive liquidity and fiscal stimulus? So I would leave this question to you, Arthur, if you can answer.
I think, Mangal, that question is for you.
Mangal, this one is for you.
So again, I will say this, that these are my views and not the ones of the central banks, 19 central banks. But clearly, yeah, the fiscal ammunition is, as I talked about earlier, is going to be very important going forward. Countries that have higher fiscal buffers and have done reasonably good management of their fiscal policy so far are the ones that are going to be probably at a better place in terms of managing the recovery going forward. In terms of what we are seeing is that there is a lot of foreign investors that have pulled out of the sovereign bond markets in Asia during the COVID crisis. Some money is coming back, but there is a rotation into domestic investors that are funding a lot of the recovery in terms of the fiscal stimulus. So indeed, the fiscal will be the biggest engine of growth in the initial stages going forward. But of course, eventually, once the vaccine is there and investor confidence returns, then I think that will propel business confidence, which in itself can bring in more private sector investment, and thereby we can see going beyond the fiscal stimulus into actual investments from the private sector, which hopefully will have a reasonably good traction in the economy to bring us back again to to not the normal yet, but it will take years to get back to that level of GDP. But at least to sort of see this recovery gain more traction going forward.
Just to add, even though I'm not a central banker, I'm not an economist as well, I think the time is about which means endless stimulus, and there is no, I mean, whatever it takes. I think central banks have been experimenting and not reducing. I don't think they're going to go back and rewind like it was done earlier. So this low interest, high liquidity is likely to continue into the medium term future. That's my view. Thank you.
If I can just add one more thing here, is that I think there is a lot of in the policy circles you will see this. One key feature is that withdrawal of stimulus prematurely can be quite damaging. So that's a very important issue, that countries that are deploying stimulus should not withdraw them prematurely, so that unless this growth trajectory is clearly much more solid.
Thank you so much, sir, for taking up this question and answering it in a very concise and a beautiful manner, which I'm sure the participant has got the answer to. So we have next question from Mr. Tiwari. What reforms are needed in India for the next wave of growth?
So this is a question which has been endlessly debated, and there are so many committees. I mean, we all know the solutions. See, the point is, for India, the one thing which we have to understand is the government should get out of the governance, and this is a philosophy. Unless we make this do, you look at any successful industry India's had, let's say the entire software revolution, the IT revolution. Why did it succeed? Because there were not too many norms around it. Once we start to have norms around industries, we really come back. And that's why all this consumer reforms which is happening, the only thing is it has to percolate at the state level, because ultimately the major work gets done at the state level. And that's what you see, that states like Tamil Nadu, for example, who have simplified and whose bureaucracy is closely involved in simplifying and getting things done, have done well in terms of attracting industries. Some of the outlying ideas which are out there and which I think should be tried out is one is Professor Panagiria's idea of the coastal SEAs, or these special economic zones. We experimented with it, but for us, it has largely been a real estate play. It has not actually translated into the real simplification of the labor and other areas which have held us back. The third thing is the land reforms. I think the land bill has really made it very, very difficult for anybody to acquire land in a seamless manner. So the only other way around it is, I think, for the government, including the state governments, to acquire land parcels, make it ready like we have in China, and then all this will happen. I mean, I can give you an example for the Delhi government recently, which is not known too much for the economic reforms, actually has just parceled out the rooftops of many of the schools for the solar projects. And because they had identified everything, made the contracts ready, a lot of investors came in and they've really taken it up. That's what is needed, for the government to really handhold and not stop and not put it out there. So these are some of the things I think we do. These are all known. Nothing is unknown. And of course, if you talk about GST or tax or any other thing, every change has got to be prospective. We can't have any retrospective things, because that again puts off a lot of investors. They're not sure how things are going to happen. And same applies to courts. Again, we have been rated not very well in terms of the contract resolution, dispute resolution, and therefore we've got to have courts which are focused on this, man them properly. So these are some of the very, very small things, I think, which we do. We have all the building blocks ready. The ease of business has to percolate to the cities and the states. Once that is done, I think nothing can hold us back. We are really, really good to go.
I think so, because these are kind of open questions which people are throwing. I would still like to leave it to you if you want to answer, because people are considering that you are there now. They can ask a lot of questions which they already have been having in their minds. So the question is, the reforms like GST, RERA, IPC now settled, which caused disruption. Can the Indian economy grow at a good rate in the next 4 years? I think it is still a debatable and a little open question. Sir, if you would like to answer, it would be an honor.
We all hope for the Indian economy to do well. So there's no question of that Indian economy will not do well. One thing is that that it is, once the pandemic immediate problem goes away, I think all of these reforms which have happened, and I sincerely hope that the agri reforms will not be derailed by the protests which are going on. Maybe they'll be fine-tuned to take care of the concerns which are there, and gradually we'll go down that path. Because in 1991, when we did all the reforms, this part was left, and no one took it up because it's considered political holy cow. But the point is, unless we reform agriculture, unless we allow market pricing to come in, people are not going to do well in agriculture, and the bulk of Indian population still does agriculture. And similarly, people have to move from agriculture to manufacturing in other areas, and therefore this reform, which hopefully will sustain, and the larger players are going to get into this. This is really going to kick up the Indian economy like anything. I mean, all the other reforms you mentioned, GST, IBC, they are still playing out. A long way to go, because GST, and again, a lot of refinements need to be done. We still have 4 rates, which is not the case with many countries. And we have a lot of commodities which are still outside the GST net, including aviation fuel, including the alcohol, and many other things. So therefore, many of these reforms, which are big ticket reforms, are still not complete. And once the GST really percolates down to everyone, which is still not the case, and the e-invoicing, which is now being rolled out, I think all of these are the building blocks. But ultimately, all the 4 engines, whether it's investment, exports, the local consumption, demand, all of that have to run together for us to grow fast. I definitely hope that the government alone doesn't have to push the economy. All of these other elements will come back. So maybe from 22, 23 onwards, we should see a much bigger pickup, and all the rating agencies are already predicting that. I don't know whether Mr. Goswami agrees with that view or not.
Yes, I'm sorry, I'm not an expert on India, but I think there's quite a lot of interest in India right now from investors, but they're just waiting in the wings to see if some of the reforms do come through as we emerge out of the crisis. So yes, there is quite a bit of positivity going forward, but of course it's all a bit uncertain until we see how we manage the pandemic first, I think.
Sir, I think because this economy is something which we all are very curious about and wanting to know, and we can closely relate it to our daily lives and business and breads. But we're having some questions, but because of time, possibly, I think we will need to cut down that. So I would like to thank you again to all the speakers here, PD sir, Ashwini sir, Mangal sir, all the speakers who are present here have taken some time and gave the consent to be a part of our annual event. Thank you so much for enlightening our participants with your valuable thoughts, sir. And it is once again pleasure to have you all here. Thank you so much, sir. And
Thank you, Mr. Tiwari.
Yeah.
Thank you, Mr. Goswami.
Thank you so much, sir.